Good afternoon, everyone. Good afternoon from Manila. Let me just open my video. Okay. So
Good
I'm
afternoon.
very happy to welcome you all here, and thanking you all for taking the time. So thank you again for joining the discussion today, and I'm sure we're going to have a very fruitful and enlightening one. So before we begin, allow me first to convey the regrets of our coordinator, Lidi Nakpil, as she is sick and she will not be able to join us. No? Okay, so we also want to share a few housekeeping reminders. Can you flash that, Nina? So you all know this very well, as in muting your microphone when not speaking, or raising hand during the question and answer portions, and waiting to be acknowledged. You can also type in the chat, and then we have an evaluation form after the event. The link will be provided in the chat. And then there's two more, I think, no? Nina, some reminders. So if anyone needs translation in Urdu, you can click that globe there down below, and you will get the translation there. No? Okay, so moving on. So we're organizing, we in the Asian People's Movement on Debt and Development have organized this webinar to highlight what you may have already been observed as the trend of the increasing share of private creditors in sovereign debts, which really raises concerns for global south countries, including our calls for debt cancellation or restructuring in the light of the multiple crises. So as you may have observed, debts are soaring in the global south, especially during the last couple of years. And there's been a soaring share or a ballooning share of public debt sourced from private lenders too. Estimates from the IMF put general government debt of low-income developing countries at about 50.3% of GDP in 2022, which is an increase from about 49% in 2021, while those of so-called emerging market economies or middle-income countries is projected to hit up to more than 67.4% from 66.1% for the same period. Now, a lot of these debts are owed to private creditors, whose shares in public external debts have steadily increased over the years, from 38% in 2000 to 45% in 2010, and then the last we saw in 2019 at 60%. So we really note that there seems or appears to be a changing structure of sovereign debts, that the share of private creditors has now overtaken multilateral and bilateral creditors in many countries, especially middle-income economies, which have been encouraged to develop and participate in debt markets. As of 2020, 63% of public and publicly guaranteed long-term external debt of low and middle-income countries are owed or are being claimed by private creditors, mostly in the form of bonds. If we look at South Asia, the share is 38%, while in East Asia and the Pacific, where we are, the Philippines, if we exclude high-income countries, this amounts to a staggering 73%. Bonds in particular are the prevalent form of debt instruments held by the private sector. So now, what do we think? How do we think of this rather non-conventional debt restructuring and debt relief mechanisms that are needed for this situation? No? How do we rethink? Private lenders pose unique issues to sovereign borrowers. For example, non-concessional terms, making the loans more costly. Another is the mechanisms for negotiating loan terms and compelling private creditors to restructure outstanding debts when the borrower has reached unsustainable debt levels or is already in deep crisis. This difficulty has become more evident with the failures of the debt relief solutions offered by the G7, such as the DSSI, which the Debt Service Suspension Initiative, which expired in December 2021, and now the Common Framework on Debt Treatments beyond DSSI. So this is indeed an opportunity, an opportune moment for all of us coming together here, because as we know, the 2022 G7 summit is just around the corner. And what do we see as, do we expect anything different or substantively progressive? So if we look at the last communique of the G7 finance ministers released in May 2022, while it recognizes the massive and reverberating implications of the war in Ukraine, and they also talk of maintaining and strengthening a safe, resilient, and open global economic system, and mounting a strategic response to the structural economic changes made evident by the pandemic and the Ukraine conflict. They also recognize the problem of Sri Lanka and the need for transforming economies and addressing inequalities within and across countries. And yet, the solutions they offer are really, more of the same, no? So, how can one solve problems with the kind of thinking, with the kind of systems and structures that created them in the first place, and served to exacerbate them over many years until the pandemic hit full force and exposed the very rotten core of these systems? So I foreground the enslaving domination of debt that has weighed down countries of the global south, deepened inequalities, and pushed us to positions of vulnerability such as the COVID-19 pandemic and other shocks. The debt burden of the South is clearly implicated in the collapse of public infrastructure for essential services, from health and water to housing and transport and many other public services. It has deepened inequalities and is now putting us in the impossible position of servicing the debt or our survival, no? As humanity. Yet it is business as usual for the G7, with private lenders again off the hook. So in our webinar today, we will hear from debt justice campaigners and policy experts who will discuss the relevant issues we should be concerned about with this trend of increasingly privately held public debts. How do we contend with these developments? Do we need additional targets for campaigning and advocacy? What arenas and platforms should we start engaging to bring forth our calls for debt cancellation of illegitimate debts owed to private creditors? What policy alternatives must we push? And what lessons can be drawn from previous attempts to restructure privately held public debts? Furthermore, which institutions are critical to engage to unlock potential mechanisms to address the increasing role of private sector in sovereign debts? What are the challenges and limits of government-initiated bilateral efforts for debt reduction? And what can the UN do? Are there regional intergovernmental bodies that can undertake strategic measures to address the issues? How about within the UN processes and bodies? So I know this is a lot of questions, and we're starting this process now of finding out more and building on our knowledge to formulate proposals that we believe are just and transformative. So this is really the challenge to debt justice movements everywhere, a challenge around which we must build equitable and thoroughgoing solutions. So thank you very much. And as I move on, because I also moved on already into the first panel, I'd like to call our colleague Bodo Elmers. He's the Director of Global Policy Forum's Financing for Sustainable Development Program. His work involves management, research, policy development, and advocacy on the UN and other multilateral institutions. Bodo?
Oh, thank you, Matt. Thank you very much.
Over to you.
Thank you very much for the invitation to speak here today. Let me first say that it's a pity that I cannot share the panel with Lily today, because Lily and we usually have a quite good division of labor where she focuses on the legitimacy or the qualitative side of the debt problem, while I focus on the quantitative side and the numbers, but I find you've shown some great videos in the beginning of the session, and they also depict very well what the problem is when it comes to the impact of high debt service on public service provisions and other questions related to legitimacy. Well, I was asked to kick off the session today with by outlining some of the recent trends related to debt issues. And I mean, one really striking thing that we've seen in recent weeks is the race to the top by central banks all over the world when it comes to increasing interest rates. Of course, led by the Federal Reserve Bank in the USA, which continues to be the lead bank when it comes to setting the conditions for debt. And the implications, especially for private debt, are massive. Private debt has never been a cheap form of finance. It has always been the most expensive form of finance that most countries could access. But now we have the situation that it's becoming, well, very rapidly more expensive. I mean, to name some figures, you probably have seen them in the news. Last week, the Federal Reserve Bank in the USA has increased interest rates by 0.75%. That was the steepest increase in more than 40 years. The European Central Bank has announced that it will raise the interest rates by 0.25% in July. That's the first increase in interest rate in more than a decade in Europe. Also, the Swiss National Bank surprised everyone last week with an increase of 0.5%. And when we look at the regions of the global south, we see that in Latin America, where countries are very closely connected to the dollar zone and need to remain competitive, central banks on average increased the interest rates by 6% already since the beginning of the year. That's of course has an enormous impact on the debt service costs and on the conditions to which countries can access private debt in this region. Remarkably, Asia is a bit of an exception at the moment. Asian countries on average have only increased the interest rate. Asian central banks on average have only increased the interest rate by 0.6% since the beginning of the crisis. But of course, this also comes with a price, and the price is for Asian countries that their currencies devaluate as compared to the dollars, and there are some capital outflows. So even this situation where countries try to not make debt more expensive lead to a situation where actually debt servicing becomes more difficult, especially the servicing of external debt, which is mostly in US, denominated in US dollars. Yeah. Well, I mean, of course, I mean, it's clearly we've clearly seen a reversal of monetary policy in all over the world in recent weeks and months, and for countries of the global north, that means that the time where governments could borrow at zero interest rate or negative interest, it's clearly over. That was a very interesting, exceptional decade we had over the last decade. For countries in the global south, debt was never that cheap, and this is also one thing that you could call well, it's related to legitimacy. The United Nations has recently called this the financial divide between the North and the South, or between developed and developing countries, that private creditors were willing to lend to governments in the North at interest rates of 0% or even negative interest rates, while especially least developed countries and African countries paid on average more than 5% on bonds sold to private investors. And in more than 40% of least developed countries, the interest rate paid to private investors was even 8%. So that means private borrowing from private sources was a huge strain on these countries' resources, even before the recent hike in interest rates started. But yeah, well, the consequence of taking out loans from expensive private sources was that least developed countries already last year paid 14% of their whole public revenue only on interest costs, and we expect that this percentage, that this ratio is going to rise quickly now. And of course, that means, I mean, each dollar lost on debt service is a dollar not paid on financing health services, financing education. So this has huge implications for the public service provision in these countries. Well, I mean, on the price question is one thing. The second question is also related to liquidity. One reason why private lending became such an important source of finance also for government in the global south in recent years was because there was simply so much liquidity on financial markets, which was searching for yield and was flowing mostly from richer countries, from developed countries to developing countries. So developing country governments had no problems to access financial markets and take out loans at higher costs, of course, but their liquidity was available. This will also massively change now. We are seeing a massive liquidity squeeze on financial markets, and the implication will be that countries will have increasingly problems to roll over existing loans. Even just refinancing the current debt stock will become difficult. We might see defaults simply because accessing financial markets will become more difficult because simply there's less liquidity available in currently and in future. We've already seen the first impact. The issuance of sovereign bonds by emerging, so-called emerging economies, developing country governments, has dropped by almost 50%, by 43% since the beginning of the year. So it has almost halved. You could see this as positively. That means that countries are taking out less loans, but in my view, that is not related to the question that they don't need the money or that they don't want to take out more loans, but simply that they can't get any. And for 3 months now, we are seeing that net financial transfers by private investors to developing countries are negative. So at the moment, or since April already, developing countries as a whole are transferring more money to foreign private investors and creditors than they receive from global financial markets. This is a situation that happens from time to time. The last time we've seen it was in March, April 2020, when the COVID-19 crisis started. But here it was clearly a shock. So here we saw a steep drop in this massive capital flight, $100 billion left emerging economies in just 1 month in March. But basically from May 2020, the situation changed again and the money came back. At the moment, I don't see why this would change because, of course, investment opportunities in the USA, in the global north, are getting more attractive now. And that means simply that the hot money, which was searching yield in developing countries over the past decade, is no longer going there. It's actually flowing back. And we might see negative capital flows for developing countries for some time to come, for maybe years to come. In my view, this has an interesting implication on the political economy because, everyone of us who followed discussions about debt restructuring, about debt suspension over the past years, has seen that developing country governments were reluctant to initiate debt restructurings, to demand debt relief from private creditors because they feared they might screw up their relations with financial markets. They were even reluctant to demand the participation of private creditors in the debt service suspension initiative, also for the same reason. They thought, we need to sustain good relations with private creditors. But if there are negative transfers from private financial markets to developing countries, there's actually no more need to sustain good relations. At the moment, developing countries would be better off if they had no relationship with global financial markets at all, if there were zero transfers. And that means that actually, there's actually no risk to take a more to take a more aggressive approach towards private creditors by developing country governments, because it is very unlikely that developing country governments will get anything from private financial markets at favorable terms in the months and perhaps years to come. So that's on the private debt restructuring debate. But yeah, well, it had been interesting. Perhaps we have some veterans on the call who are still around or who were already around when the 1980s debt crisis took place, because the situation that we're seeing today is very similar to the one that we've seen in around 1982 when the Reagan government came in the USA, and the head of Treasury, Volcker, or the head of the Fed, Volcker, at this time started to raise interest rates in the USA massively to curb inflation in the USA, to really satisfy national needs, which eventually sent a shockwave through global financial markets and started the so-called third world debt crisis, which eventually took 20 years to solve. So we're having a very similar situation at the moment when we look at the policies of central banks and the and the situation in developing countries. Well, that on the short-term situation. On the long-term situation, I mean, Mary, you said this already in the developing countries, the policy change or the rising interest rates hit developing countries now in a very vulnerable situation because they became massively, I mean, debt stocks have been rising massively. They have simply more debt, and also the debt composition has been changing. So they have, as a percentage of the debt stock, they have less concessional debts by multilateral development banks. And this is a type of debt where the interest rate is administratively set, so it's not changing. But they have a lot of debt now from private sources, which of course react sensitively to changing interest rate levels. I mean, some of them don't have a flexible interest rates anyway. But even the ones with the fixed interest rates, when a bond matures, expires, when a loan expires, you have to refinance them. And of course, you will have to refinance them at worse terms. In future, you have to pay higher interest rates to roll over an existing debt stock. So this is an extremely bad situation. So you could say, when you look at the last 20 years or so, I think, I mean, 20 years ago, we had very bad financing conditions. We had high interest rates for developing countries, but at a very low debt stock. Then we had, like 10 years ago, over the 2010 decade, we had very good financing conditions, lots of liquidity, low interest rates, and increasing debt stocks. And now we have the situation that a situation where developing countries, not actually also developed countries, are heavily indebted, meets the situation where the financing conditions are very bad. And this is, of course, an extremely toxic situation. So yeah, quickly to the implications. I mean, working on debt restructuring, the two G20 initiatives, the DSSI and the Common Framework, you mentioned them, they've been a huge failure so far. The DSSI expired anyway. The Common Framework has not achieved anything so far. So there are no institutions in place to cope with the situation. I'm not going to talk about this in detail because this is, I think, the subject of the panel that follows. We might even see, in my view, I mean, in the private sector, the situation is not bad as is not easier than in the public sector. We might also see that many private firms, heavily indebted private firms, get bankrupt. Of course, it's also a problem for individuals who took out mortgages or saw the situation of rising interest rates, and it's even a problem for banks if we see massive increase in non-performing loans. So this situation might well cause a new financial crisis, and of course, debt justice campaigners or economic justice campaigners also need to be aware of that we might see a new situation where banks want to be bailed out by public monies. This is a problem we know in my region, in Europe, very well. It could even be the first financial crisis, which is a shadow banking crisis, where the BlackRocks and so on of this world are involved because they are heavily exposed in these categories, especially in sovereign bonds of emerging economies. To close my statement, well, I mean, I think when we look at the financing for development debate in general, I think it has implications and the situations for the sources that countries can use to finance development and public services. I think public debt is becoming an increasingly unattractive source in this environment. So I think there's a need to look more at domestic resource mobilization, at official development assistance and other non-debt creating flows. And perhaps the last statement, because I think this webinar, of course, takes place 1 week before the G7 summit takes place in Germany. I mean, the G7 hasn't been that active in the area of debt policy recently. They transferred most of this responsibility to the G20 in recent years, but it's still extremely disappointing that it doesn't feature at the moment. The agenda of the G7 summit, to the extent we know it, is about Ukraine. It's about food crisis, which is of course an important topic. It's also about climate, which is not less important. But I have very low expectations that we see anything big coming out of this G7 summit as related to debt. So well, there's certainly a lot of work ahead for debt justice campaigners, and I'm not sure if the G7 is the adequate forum to address for this kind of work. Thank you. I stop here. Thank you very much.
Thank you very much, Bodo. And it's great that several important things were really highlighted, like higher cost of borrowings for the South vis-a-vis the North, and really, lending being run as a business, no, to profit from, and far from the development goals that lenders claim. And also, we see that how debt dependence really turns countries to accept conditions almost at any cost, no? And so this becomes a vicious cycle that we borrow to pay for debts, and the accumulation just goes on and on. And also mentioning the failed debt relief, as well as the G7, although it's not talking too much about the debt, it's not veering away either from its proposals as before, no? And one of that is not requiring the private sector more forcefully to participate in debt relief, or in following still a proposal to, apply the comparability of treatment principle. So at this point, I'd just like to ask the participants if you need any clarification. You can raise your hand or type in the chat. Okay, so perhaps our participants are still warming up. And so moving on, I'd like to move to the next session, which will really concretize what are these, or who are these private lenders, and what has been the experience in pushing them to participate in debt relief, what has been the experiences in other countries, and perhaps also learning from those experiences, and what can we expect if that also manifests in more countries in the South, no? So for this session, we'd like to play the video sent by Patricia Miranda, who is the Advocacy Coordinator of Red Latino America por Justicia Económica y Social, which we more commonly know as Latindad.
Good afternoon, good evening, and good morning, very early in the morning for the people that are in my side of the planet. Thanks to APMDD for the kind invitation. I hope that with this video, I will contribute to the objectives of this event. I will share with you briefly the situation of debt in Latin America and the experience of Argentina in its debt restructuring process. I will start briefly by reflecting some of the impacts that the multiple crises have in our region. We have a contraction of almost 8% in terms of economic growth, 8% of GDP due to COVID-19. 3 million of companies closed, and among them micro, medium, small and medium enterprises. We are 8% of the planet, but due to COVID-19, we had 28% of deaths, reflecting the house scars and the lack of preparedness of our health systems. Of course, our extreme poverty has increased, and we still have 30% of lost jobs to recover, knowing as well that 70% of our employment is in the informal sector. Before the pandemic, Latin American countries already had fiscal deficits. And with this limited fiscal space, our countries had to increase debt, new debt, bilateral, multilateral. The IMF is back in our region, and also with the issuance of sovereign bonds and domestic bonds. I want to show you here in this chart the increase of external debt in 1 decade, but also I want to emphasize on the red bar that reflects the importance of bondholders in the region, and that it had an increasing trend in the last years. I also want to show you the importance of the domestic debt, which will be important to share with you the experience of Argentina as well. You can see here in the green bars, the domestic debt that in some cases, in some countries, is higher than external debt. And of course, both have different risks in terms of currency in the one hand, but also in terms of the capacity to guarantee a rollover in the middle and long term, and moreover in a context of crisis. Each one have a fiscal impact or a monetary impact, and in the case of Argentina, this was also important. I also want to reflect the interest rates for the long-term public debt in the region, and you can see here that well, the line with dots is the United States interest rate, but I want to reflect for other countries in the region. And in the last months is the minimum has been 5%, and in the worst cases has been near 12% in terms of interest rate, to reflect how expensive the issuance of sovereign bonds is for our countries. In the specific case of Argentina, and here we can see the increase of the external debt of Argentina, but I want to emphasize on the light blue bar, which reflects the size and the proportion of bondholders. And this is why Argentina started the renegotiation with private bondholders, and with a plan to follow with the IMF and the Paris Club. So I'm going to share with you some of our views on what was and how was the renegotiation that Argentina had to face with private bondholders. In 2019, Argentina reached already unsustainable levels of debt. By that time, the interest that they paid reached the same levels they had in 2001. And by 2020, the ratio of debt to GDP surpassed 100%. Argentina started with private creditors because of the proportion, as I showed you, but also because it was because of how close the next payments were. And they faced this from two angles: the foreign and the domestic, and started with the first one, with foreign law governed bonds. I want to reflect, I want to share with you 5 points here that I think could somehow make a summary of what was this renegotiation. First, that it was a bilateral renegotiation between Argentina and private bondholders. With the initiative of Argentina to reach directly private bondholders. And that means that somehow Argentina tried to make this independent from the IMF. The IMF, as past experiences of debt restructuring processes, the IMF was not leading or heading the negotiations. And it was mainly Argentina who, Argentina had launched a plan. It was called the Restoring Public Debt Sustainability Plan. And this plan had a realistic scenario of what needs to happen in order to recover sustainability in the middle and long term. The IMF had a low-profile role in our view. Around those weeks, the IMF launched a report on the debt sustainability analysis for Argentina, and it mainly said Argentina's debt is unsustainable, and Argentina cannot repay its debt. And that was an important report that supported Argentina's government during the process. The second point is the asymmetries in the renegotiation process. I mean, the creditors were more homogeneous in terms of they were institutions or holdings of investors. They organized themselves into 3 groups of bondholders. So the Argentina's government had to deal with those 3 groups. But overall, they have more power and capacities, legal experts to face and push for a really hard renegotiation process. In the other side, there was Argentina that also have a very important team, a legal team and a technical team that could face this process. If we think of another country in the region that it's not Argentina and it's a smaller country, it would be really not likely that another country could have this strong team to deal with such a renegotiation process. The asymmetries were in the access to information, to timely information and to transparent information. To have the same information for both, to really have a fair renegotiation process. The bondholders asked to improve financial terms, to improve the offer that Argentina made. Argentina made basically 2 offers, but the push from creditors to improve interest rates, to achieve their expectations in terms of net present values. And it was a process of back and forth over negotiations with these 3 groups. The third point is that overall, from the creditors' view, it was an act of good faith from Argentina's side. There were some tough moments, but overall, we think that having this view contributed, but also the involvement or the support of other stakeholders that strengthened the Argentinian negotiation position. Global stakeholders as the G20, but also stakeholders at local levels. Specifically with this renegotiation with private creditors, which is not the same case if we speak about the IMF renegotiation process. Another point is that it was in the middle of a crisis, a multiple crisis, and this process also reflects that it was not timely. It took months of negotiations with external private bondholders, more than originally planned by Argentina. And the fact of being in the middle of a crisis with so urgent needs also led Argentina to finally ask, after they rejected the first offer, creditors didn't really like the second offer, but the context of crisis and the situation of the population, of all the social impacts of the crisis on the population, led Argentina to say, creditors, we are not asking you to lose your money. We are asking you to gain a little less. And they also say it's now, because later on it will be more complex for Argentina given its unsustainable situation and the crisis. So this was also I think this also contributed to have a process that finally was accepted by creditors. It was also, I think it's important to say, it was mostly a virtual negotiation by Zoom because we were in pandemic. And the final point is the collective action clauses. Argentina really used all the CACs that were in the bonds and achieving more than the 2/3 of creditors that they were supposed to achieve. At a point that creditors said that Argentina was being abusive with the use of CACs. And well, Argentina was in its right, and it was the collective action clauses were in the bonds, in most of the bonds that were renegotiated. And this was very important to achieve a final renegotiation. What are the results? The results were that finally, 99% of the outstanding capital of debt in foreign law was restructured, and 100% if we talk about the domestic bonds that received the same offer. The principal didn't experience an important cut, and that was part of the hard negotiation process. The cut was 1.9%. The other thing was, in terms of the financial conditions, the interest rates that went down from an average of 7% to 3% on average, depending on the bonds. And this made a total in terms of if we compare the net present value that creditors were concerned about, it was $54.88 US for every 100 US dollars in face value. Nevertheless, this is more close to the 56 asked by creditors than to the 39 initially offered by Argentina. So this also reflects how hard was the negotiation, and that anyway, the balance is probably more in favor of the creditors. There is a grace period. It's reduced, but it's not a long grace period. But overall, it's a postponement of payments. It is a financial relief for the period of 2020 to 2024 that reduces the debt payments of 42 billion for this period, which is important for the budget and in terms of fiscal commitments and expenditures for Argentina. Gives air to the economy. However, payments then start in 2024, and this is still, we are still in a complex scenario, in a context of crisis, in a context of interest rates that are rising. So it is a good renegotiation for a short term, but there is still uncertainty with the context and also with the other renegotiations that Argentina is facing. To sum up, this example reflects several items of what civil society organizations have been claiming for many years, and still reflects the need, the urgent need of having a fair, a timely, a binding, an independent and comprehensive debt restructuring process. Argentina is dealing separately with different groups of creditors. Now is the IMF, the Paris Club, and this is taking really a long time and in a context of crisis. So this is, again, I think one of the good examples and experiences with lessons learned for our demands as civil society organizations, but also for other governments in terms of the capacities and the needs if they are about to face a debt restructuring process, all the issues of asymmetries and lack of information. Those are things that are still not solved, not even in the current G20 policies as the common framework, for instance. All these reflects that we urgently need a different process, a new and different debt restructuring process. I will stop here. Thank you very much and greetings to everyone.
So thank you very much to Patricia for sending that video, and you may have noticed several similarities in our region, such as the huge domestic debts, and also very insightful the challenges that Argentinian people faced in negotiating for the reduction of public debts from sourced from private lenders. So this is also a problem that perhaps our friends from Sri Lanka can speak about, because one of the major creditor groups behind the Sri Lanka debt problem is our private creditor groups, and it is the typically they seek full repayment of bonds through litigation, or costly and very long processes of litigation, rather than participating in debt negotiations. So we can learn more about these private lenders, and this one is the experience in Zambia. So I'd like to call on Tim Jones. Tim is Senior Policy and Campaigns Officer of Debt Justice, or formerly Jubilee Debt Campaign, and he has done work on Zambia's debt burdens and on how its public financial resources are threatened by the world's largest fund manager, BlackRock, and perhaps what civil society is doing to address this now. So Tim, over to you.
Thank you, and great to be with you all. Good afternoon, good morning, good evening, wherever you are. So I'll cover a bit about restructuring debt with private creditors generally, and then talk about the Zambia example. And what I want to start off saying is that there are definitely challenges to restructuring debt and defaulting on debt. But it is also in the interests of private creditors to make it seem like there are more challenges than in reality, so that governments don't restructure and governments keep paying them in full. And so that's how they make the most profit. So I think that means there are two challenges for us as campaigners. One is to change the system so that it is easier for countries to default or to restructure their debts. But on the other hand, the challenge is to counter the private sector propaganda that governments cannot and should not restructure or default on debts, rather than reinforcing that. Because what happens then is that governments just pay debts for too long. And I think many of us would see that's what has happened in Sri Lanka. And so then eventually the default and restructuring happens when a country is in a weaker position, because all the foreign exchange has already been used up on paying the debt. So why do private creditors agree to a debt restructuring if they want to make as much money as they can? The reason is because they fear that they'll get less if they don't. So in order to get private creditors to agree to restructure the debt, there has to be a default or a threat of a default, so that they are willing to do so. Debt restructuring is any change in the terms of the debt, which can include cancellation, but it can just be minimal changes as well, as we see too often, changes such as in pushing debt payments into the future or reducing interest rates a bit, rather than a large scale cancellation of debt that enables the situation to actually improve. So I think governments tend to fear restructuring and default for the wrong reasons, because the private sector have created this view that if you restructure your debt, it means you will never be able to borrow again. In reality, governments with high debts already can't borrow, and we'll see that in the case of Zambia. But if a country successfully restructures its debt, so reduces the debt level down, it is then able to borrow again. So actually the truth is the opposite of what the private sector lobby, is that if you have a high debt, you tend to not be able to borrow new external loans from the private sector. But if you restructure that debt, get the debt down in size, then you can borrow again, possibly too much so. And Patricia could tell us more about this, but the Argentina case from before the current restructuring, they defaulted on debt, went through many years of arguments with vulture funds. And then when the Macri government came to power, despite having had a long history of defaults, they went and started borrowing huge amounts again at high interest rates. So in many ways, the private sector is too willing to lend again following restructurings. So the private sector creates this myth that if you restructure or default, you'll never be able to borrow again in order to make governments keep paying them. But there are some genuine problems with restructuring. So Patricia has talked us through all the coordination problems with lots of multiple creditors. There's the threat of being sued in London or New York. So most international debt contracts are governed by either English law or New York law. And I think importantly, there's the moral perception of failure, that it's just seen as a negative thing to default or restructure debts, whether that's within a country or within the international community, which again is a perception I think we need to challenge, that actually this is the way out of a crisis. Defaulting and restructuring is the way out of a crisis, not the cause of the crisis. So to talk about Zambia, debt justice in the UK, we've been campaigning in alliance with the Zambian Civil Society Debt Alliance on Zambia's debt default and restructuring. So Zambia borrowed high interest loans from private creditors in the mid-2010s. And then from around 2016, 2017, those loans have been traded on financial markets at low prices, which means two things. One, the companies that have bought up those debts stand to make huge profits if they're paid in full. And two, it meant that already from 2016, 2017, private lenders weren't willing to lend more to Zambia. But Zambia kept paying at huge cost within the country. So between 2019 and 2021, spending on social services was cut by 21% per person. So that's a huge extent of austerity that was introduced in the name of paying the debt. Then at the end of 2020, Zambia finally defaulted on the debt and started a process of seeking to restructure it. That restructuring is happening through this new process the G20 has created called the Common Framework, which so far is not necessarily adding that much more to what already existed, but was potentially a way for creditors, particularly on the bilateral side, on government creditors, to coordinate more. There are 73 countries in the world eligible, the G20 have made eligible for the Common Framework. That includes countries like Pakistan and Laos. It does not include Sri Lanka, but much of the lessons still apply to a case like Sri Lanka, because the Common Framework doesn't actually do that much. Ultimately, it still comes down to a negotiation between a government and its creditors, and the main thing driving those private creditors is can we get more money back? Well, how do we get the most money back? Now, in Zambia's case, they've defaulted on the debt, so the private creditors aren't getting paid anything at the moment. The largest holder of Zambian bonds is the company that's already been mentioned, BlackRock. They're the largest asset manager in the world, and we've calculated that they could make 110% profit out of Zambia's debt if they're paid in full. So the combination of the fact that they bought the debt at cheap prices and that their high interest rates mean that they stand to make huge profits. It also means that even if they cancelled half the debt, they would still break even. So we have been campaigning for them to cancel the debt and other private creditors, but using BlackRock as the focus, but as a way of putting that pressure on private creditors. Another narrative that private creditors and Western governments like to promote is that debt problems are all caused by China. And so to put all the focus on Chinese lending and not on private creditors. So we've been trying to put the focus back on private creditors. The negotiations, in one sense, have been taking a long time. So Zambia first applied for this debt restructuring at the start of 2021, and no debt has yet been restructured. There are multiple reasons for that, including the political process in Zambia. There was an election and a new government came in. But also the fact that there is no process for this common framework has held the whole thing up. But negotiations are now beginning. There was the first meeting last week between Zambia and its governmental lenders like China and the UK. And now negotiations should begin with private creditors. So on the one hand, that is very frustrating for Zambia how slow the process is, but on the other, they're not paying the debt, and actually there's evidence that this year in the budget they've managed to increase social spending. So in some ways, this is yes, the best situation would be if you could have a quick restructuring, get debt cancelled quickly down to a sustainable level, but it's better that this process takes longer than Zambia signing up to a bad deal and starting to pay too much to these creditors again. And the longer Zambia is in default, the more pressure it puts on private creditors. So going back to Argentina, when they defaulted in 2002, it was 3 years between the default and then agreeing a restructuring with most of the private creditors. And because that process was so long, they then managed to get 2/3 of the debt cancelled because they remained in default for so long. In the UK and other countries, obviously we focusing on the creditors that are based in our countries like BlackRock, but also on what political measures our governments could take, challenging them to change the system. So one is legislation could be introduced in the UK and New York to make debt restructuring easier, or to enforce it on private creditors. This happened in the UK in 2010. An act was passed which effectively enforced the heavily indebted poor countries debt relief initiative on private creditors. And we would like to see the same thing again. Similar campaigners in New York and Jubilee USA and New York Communities for Change have been pushing for similar legislation there. And also going back to the point I made at the start, as the reason private creditors accept the restructuring is if governments default or threaten to default. So the other thing that G20 governments could do to support debtors is give more overt political and financial support to governments to default on creditors who are unwilling to sign up to a debt restructuring. So in Zambia's case, it makes its offer to private creditors. If any of those refuse, then the G20 governments just say, well, you should just remain in default on those creditors, then we will still give you our debt cancellation so long as the private creditors are not being paid. So the Zambia case is still very much ongoing, and crucial points might come in the next few months, and it will be it's an important case for many other countries, particularly those eligible for the common framework, in terms of setting the precedent for how these restructurings work. But as again with all these negotiations, it feels like we have a challenge that we are pushing for this cancellation for private creditors, outlining how they've delayed the process. But also, actually, if Zambia remains in default, then it's not so bad, and that just increases the pressure on private creditors. So defending Zambia's right to keep doing that. And so my final point is the one I made at the start, just to re-emphasize. So as campaigners, I think we have two conflicting communication challenges that we need to get across. One is challenging how the system is built in favour of creditors and the powerful, and we want to critique that and campaign for changes to that, but also challenging the private creditor narrative that default and restructuring is a really difficult thing to do and governments just shouldn't do it. And we need to challenge that to empower governments to default and to restructure their debt sooner rather than to keep paying and just creating more of a crisis. Thank you.
Thank you very much, Tim, and very interesting insights. So at this point, any questions from the floor or clarifications? So Tim also mentioned Sri Lanka, and I hope if we have colleagues here, they can also share a bit about the situation in Sri Lanka. So we know that the IMF has really been, very closely in touch with the Sri Lankan officials, and I think they visited Sri Lanka, as Hemantha shared here in the chat. Hemantha Witanage from Sri Lanka, and it was also shared that the austerity conditions are really numerous. So this does not look very well for people already at the brink of starvation, and all the incredible price hikes that really put lives at risk. So any questions or additions, clarifications? Okay, so hearing none so far, I think, I think that's Hemantha.
Yes, and thank you for the
Hi, Hemantha.
Hi.
So,
Thank you. Thank
Go
you for
ahead.
the opportunity. I cannot open my video.
Okay.
But I just want to share that yesterday IMF also came to Sri Lanka. I think by 2020, our debt sustainability level has already passed like 101% by 2020. And I think private creditors percentage is really high. And also for China, government and the China private banks are also very, very high. So what IMF wrote somewhere in May that at least 7 billion annual repayment we have to make, but unfortunately because of the foreign remittance is not adequate, so we are in a deep crisis. At the moment the whole country is on the roads for waiting for diesel, petrol, and we don't have coal, we don't have LNG, we don't have LPG gas, and energy crisis, food crisis. They are really dangerous situation. It's a time bomb. Unfortunately, I don't think government has any solution at the moment. And I learned that IMF, although IMF has started restructuring the other loans, but they have told the government that they have to deal separately with the Chinese loans. I think, but China has originally they have said that so we have to borrow again another 1.5 billion or something, and then repay some of those debt. But I don't think Sri Lanka is willing to do at the moment. But the problem is actually now there are people committing suicides other than just queues. It's really a very, very dangerous situation in Sri Lanka at the moment. We really need to have this debt analysis and also follow the IMF process. Of course, some of us has some very big concern about why we need the IMF support, because it's another neoliberal agency, and they might not resolve our issues, and we will be more indebted if the IMF comes here. And their solutions actually are real problems, because they are proposing, I think this is somewhere outside I have learned, one of the politicians told me that at least 10 10 government assets, including the Sri Lankan Airline, Ceylon Electricity Board, the Water Board, and these kind of government public entities have to privatize in order to resolve this issue. So I think so we really need your support, especially the speaker's support. I think so they have a lot of good experiences on the Zambia situation and the Argentina situation. Thank you.
Okay, thank you, Hemantha, and that really speaks to that factor of political will, no? Which is also why we are campaigning nationally vis-a-vis our own governments for either collaboration or non-action on these issues. So, may I call on Saeed? Saeed is from the Pakistan Fisher Folk Forum. Saeed, go
Yes, thank
ahead.
you. Uh, no, that's a good Sri Lanka and Pakistan, the both example to go to more. They went to IMF from more than 16 to Pakistan, 17 time. But both countries' economic condition worse. So you see the Pakistan's. Yes, there's a one very clear example was the Argentina. It's declared the default, but I think in Pakistan is not that's a way to call themselves a default, and we are stuck in a huge burden of loans. There's in count in rupees, there are 53 trillion rupees debt. So there's a big chunk of budgetary money went to the repayment and interest rate. There's a there's almost 130 billion, but maybe it's $32 billion debt. Pakistan's what this year, the last year, this they introduced a bill to seal the limit to borrow money from the state bank. But the alternate, the government borrowing much money from the private sector, private banking, and with huge 16, 17% interest rate, which call is a super interest rate. So that's why this budget, the government charge a new income tax on the super income tax on the banking sector to recover some their own borrowing money. The situation is initially the Pakistan's budgetary session, the huge amount of the budget was went to the military expenditure. But now the debt and repayment of debt and interest rate are higher than other all budgetary. Just like yeah, Pakistan government borrow 1,335 billion rupees from last years, so which is very huge. So if this is continue, it must default the government's all the financial system. And what they did last year, they they they, they bring all money from different ministries to the government, central government, to repay and make the new budget. So I think the private lenders burden is more than other, maybe the IMF, World Bank, ADA, some country to country, but internal private borrowing is huge burden. So government should come out from this. Otherwise, in future, the public sector and the welfare is some people, it's not be possible for Pakistan government. Thank you.
Thank you, Saeed. So those were thank you for the sharing also. And as you know, Pakistan's central bank governor is a former IMF official from Egypt. No? So we have a hand up from Anna Henche. Anna?
Thank you so much, Mai. Thank you all, Bodo, team, Patricia, everyone talking for your insights and all the information shared. I will. Well, I have a question on what you have been asking, and then also for a suggestion. It is about the comparability of treatment of private creditors, and how can we encourage multilateral and bilaterally this participation. And as long as I know, the common framework has one improvement is the possibility of having standstills. And for what I know, the standstills are, the private creditors will not participate ex ante in the standstill. So my question is, if a country asks for a default or declares in default, do they still need to be repaying the debts to the private sector? Because I thought, with the standstill, they were not obliged to. But as far as I know, this mechanism of standstill is just for bilateral and multilateral and not for private. So privates will only be added to the standstill ex post. And the reason I was given why not the ex ante is that to require the participation of private creditors ex ante and in abrupt form could put in risk this access of the debtor to the international financial markets. And also there are operations of the private sector that are tied to legal clauses. And if there is not, these clauses are not achieved, this could run in an early charge-off or amortization. So what is the, how can we put a solution on this?
Yeah.
I don't know if I'm expressing myself correctly.
Okay.
How, and Tim was talking about legislation to be introduced in New York or in the UK, and so to make this possible. So I'm just asking for kind of possibilities and solutions on this. Thank you so much.
Okay. Thank you, Anna. And I think Anna's question can really benefit from the responses of all our speakers. So with your indulgence, we'll hold that thought about Anna's question and then move on to our third and last session with our colleagues from Society for International Development and Eurodad. So first, may I call on Pooja Rangaprasad? Is Pooja here? Hello, Pooja?
Hi, May. Can you hear me?
Okay, yeah. So Pooja works as the Director for Policy and Advocacy and Financing for Development in the Society for International Development. She leads and facilitates strengthened policy dialogue and advocacy efforts of the civil society financing for development group towards UN member states. Go ahead, Pooja.
Thank you so much, May, and warm thanks to, I think, everyone who's presented and kind of shared updates so far, which has been really useful and interesting. I think, because I'm so embedded in the financing for development process, I probably have, I'm probably going to focus a little bit more on thinking about the international architecture and kind of like what's really missing, at least from my perspective. Because the financing for development process was really something that developing countries pushed in the aftermath of the Asian financial crisis of the late 90s, because of the recognition that really they don't have the fiscal and the policy space at the national level because of very global systemic challenges. including the fact that the global economic architecture is really, excludes countries of the global south in decision making. And so we're really left with very biased and ineffective global standards and norms in terms of addressing all of these challenges. And so when I really look at the international debt architecture, where you have Paris Club and G20 that are kind of discussing sovereign debt issues and challenges, restructuring, the role of IMF and World Bank, we kind of already heard from others, whether that's on debt sustainability assessments, debt data and policy, lending, restructuring, even the role of OECD on debt statistics, where are countries of the global south in all of these decisions? And where are people of the global south really represented? And so for me, this is really the core of the problem, that if the only way to resolve it is that we have to keep going to creditor-dominated forums and expect that that will magically address the crisis of global south countries, we're not going to get very far. And we've seen that now repeatedly with history. And then, of course, you see now, of course, a much more complicated creditor landscape. And, you see a lot of finger pointing, with creditors pointing to each other as the problem. So you see G7 and they're like, China is the problem. And you look at statements from China and they're like, oh, World Bank is not participating. They're the problem. You look at World Bank and they're like, oh, private creditors is the problem. And the reality is they're all correct. They're all part of the problem. And yet we have no way to enforce participation of all creditors. We have no international legal framework, no norms or standards. And of course, developing countries, again, have attempted to do that, most notably in 2015, at the time, of course, also led by Argentina. And we've heard of, their experience historically, and so it's not surprising that they led it in 2015, but one of the things developing countries were really calling for is the need for a multilateral legal framework to address sovereign debt crisis. There's also work done by UNCTAD, by independent, experts and human rights rapporteurs on looking at this issue of what a multilateral legal framework that really upholds human rights and gender equality can really look like, what kinds of norms and standards and principles. But also, for instance, UNCTAD has talked about the need for, multilateral legal framework, debt workout mechanism, whatever we want to call it, but norms and standards that enforces provisions allowing for a temporary, standstill on payments due, whether private or public, an automatic stay on creditor litigation, and eventually, of course, debt restructuring and debt cancellation. So we have this massive vacuum. And of course, it's not surprising then that the only option left is you have every developing country on their own against all these creditors. And, we heard, of course, from Patricia, that experience of the power asymmetries when you're up against very coordinated creditor clubs. And the ones who are on their own are, of course, individual developing countries. And so the idea that we keep going back to this very broken architecture to fix what is a very difficult and complex issue with this huge vacuum of no norms and standards, really for me is, I think, the core challenge that we really need to be focusing on. I think for me, this is why I keep coming back to how can we really start to prioritize this sort of the need in the UN to have this multilateral legal framework? Because the other thing for me that's important is the need for also developing countries to be coordinated, which is only possible in the UN, whether that is as groupings of small island developing states, LDC group, grouping of middle income countries, which is also very strong on this issue. And then, of course, the very large grouping is G77, but there are many ways in which they can protect their collective interests, which, once they're on their own against all these coordinated creditor groupings, that's out of the window. But yeah, I think coming back to the importance of really having a principled process of addressing sovereign debt crisis, where global South countries are at the table as equals, with a vote on what the direction should look like, with an opportunity for people of the global South to also then be, where this is transparent, you can hold your governments accountable, and most importantly, having legal norms and standards that actually enforces some of these things that's required. And finally, I think the risk of being sued that was mentioned is, of course, not just through national courts in London and New York. Argentina was also dragged into international arbitration through the investment agreements that they've signed. And again, there's also huge, lots of research that has been done on this, including by independent, human rights expert Juan Pablo, South Center, of really the risk of developing countries, being dragged into international arbitration, the complexities of the clauses of investment agreements that makes it very difficult for developing countries to unilaterally make the decision to default. And so again, we come back to, I think, a lot of these. I'm conscious we're running out of time, so I'm trying to get through a lot of things quickly. So Yolanda gets, I think, the last word. But yeah, I think I come back to the fact that we're really missing that kind of systematic, international system that allows them to have decisions that are really in the interest of the people of the global South. Otherwise, we're getting trapped, I think, in the same old IMF austerity conditionalities, the same old Paris Club G20, and we know that script all too well. I will hand it over to Yolanda now. Thanks, May. Sorry for rushing through.
Okay, no problem. I think we can also beg the indulgence of our participants to stay a little bit longer. No? So, Yolanda, over to you.
Yes, thank you, Maya, and thanks everyone for the very interesting webinar so far. Let me start by trying to address some of the questions that Anna Hensch posed on the common framework. Because one of the problems with the common framework is that there's not really like a global international agreement on what the common framework is and how it works and how it is enforceable to the different creditors. It's just a sort of a gentleman's agreement, and it's gentlemen's because most of them are men, among G20 countries. Most of them creditors, not all of them, but most of them creditors. And yes, they are discussing, not yet approved, the possibility of applying a standstill, a moratorium, when a country requests a debt restructuring within the common framework. This wouldn't be available for Sri Lanka, for instance, because Sri Lanka is not a DSSI eligible country, so not within the common framework. So it's only for a small group of 70 something countries. But the problem is, so the talks within the G20 are that this debt standstill might be approved if they come to that decision and apply only for bilateral and maybe multilateral creditors. I don't think multilaterals are there's such an agreement, and that's where the finger point enters, like China requesting the World Bank and the multilaterals also to enter into that into this. But not to privates, because with private creditors, it's not enforceable. I mean, they are not on the table, they cannot agree with that, and the G20 doesn't have any tool to enforce that debt standstill. So yeah, they have this narrative that applying this standstill would create a credit downgrade for the debtors. But that is also, as Tim was saying, that the narrative that we need to challenge. And it's not the biggest problem. The biggest problem is that they don't have any tool, any legal framework, as Pooja was saying, to enforce that debt standstill or the comparability of treatment and the debt restructuring into private credit. So in all, the common framework remains sort of a voluntary scheme for private creditors. I'm going to mention just a few challenges that I think we have as social movements and CSOs when it comes to advocacy and campaigning with this context that my colleagues have set up. One of the main ones, as Tim was saying, is challenging the narrative, and challenging the narrative also when it comes to market access. That the objective of any country should be maintaining and keeping this market access. Not only, as Bodo said in the beginning, that most of these countries have already lost market access, but also that maybe development shouldn't be dependent on whether a country has access to financial markets, and we should work on eliminating illicit financial flows and sorry, mobilizing domestic resources and maybe domestic financial markets. A second challenge is how we deal with this increase in domestic debt as well. Because when in the past we were campaigning for debt cancellation, we mostly had very clear, let me put it this way, like a clear enemy, like a clear target, the IMF, the World Bank, this private bank, this bilateral creditor. Today, the targets are more diverse, are more complex, includes domestic actors. And when you ask or when you call for debt cancellation from domestic financial actors, you might be causing an internal problem. And that is something that we need to consider. But also, Bodo and Tim spoke to that, the opacity of who these private actors, private creditors are. Even when you retrieve the information on who they are not very well known organizations. There are investment funds, some of them, or one of them is well known, which is BlackRock, but most of those investment funds, they don't have offices where you can go and campaign in your own countries. The offices are in London or New York, so it's not so easy to organize campaigning to request debt cancellation from those very unknown investment funds. These actors also don't have a sort of a public duty. They are not the World Bank, which is a public entity, and you can request their obligation to respond to the public common good. Sorry. There is also this huge difficulties, even impossibility to know where, when, and how the decision making on debt restructuring and debt cancellation is being made. As Pooja was saying, there is no legal framework, there is no really rules. Even within the common framework, there are no rules on how these negotiations should go on. It's impossible for citizens to actually follow, not to say participate, and give their opinion on how this should be made. No clear rules or no rules at all. So that makes it even more difficult for us to organize our campaigning and our advocacy. The proliferation of bondholders' debt, so bond issuing, also makes it more difficult for us to make the link between, let's call it, illegitimate projects or illegitimate investments, like investments, for instance, in fossil fuels, with that funding, because bond issuing is for general budget. So that campaigning that we still do, and we used to do more often in the past, linking a loan from a bank or from the World Bank or from a bilateral creditor to a concrete investment, it's much more difficult to do when it comes to private investors, particularly with bondholders. And I think I want to get one of the sentences that Patricia mentioned, which I think it makes it very clear how unfair and how messy the whole situation is when it comes for developing countries to try to restructure and their debt and get debt cancellation. And she mentioned that in the case of Argentina and many other countries, it all comes down to which lawyers you can afford. So when you find yourself in that situation, if you're a government, which lawyers you can pay for are going to make the whole difference on the outcome of that debt restructuring. And that is absolutely not just unfair, it's outrageous. And this is how messed up the system is. So linking with what Pooja was saying, we need those structural reforms. We need a rules-based, transparent framework, also to be able to apply citizens' oversight, citizens' participation into that process. So even if it's just for that, I think it would be important for us to join forces on those structural reforms. And let me just finish by one sentence. What we need more than ever, the biggest challenge we have is to keep building this global campaigning. So working together, people from Pakistan, from Sri Lanka, from Zambia, from Argentina, from Ecuador, from Malawi, from the different countries, from Laos, from Lebanon, from Morocco, Egypt, joining forces with also campaigners from the global north, obviously, in tackling this system, in not just calling for debt cancellation, but calling for a systemic reform. Thanks, and sorry if it went too long.
Thank you so much, Yolanda, and apologies, I forgot to introduce Yolanda. Yolanda is the Policy and Advocacy Manager on Debt Justice of the European Network on Debt and Development, or Eurodad. So thank you so much. So I invite all the other speakers to also address the questions raised. I think there was a question about what happens if countries default, and then also perhaps the messages that you would like our participants to remember long after this webinar is over. So Bodo, Tim, Pooja, and Yolanda. So the floor is open for responses to the comments so far. Is Bodo still with us?
I'm still here, yeah.
Okay, okay. Go ahead.
So, I mean, these were quite complex questions, so it's difficult to find a short answer. But first, on the question of comparability, I mean, let's say, first, let me support Tim that, it's really important for countries to start that restructuring processes early and to not procrastinate over it. It's debt restructuring when you have a debt problem is a bit like going to the dentist when you have toothache, basically. It's a painful process, but when you procrastinate over it, it just gets worse. And it's really, you really impoverish your own population and then decapitalize your economy if you don't. On Anna's point, let's say, private creditors should pay a price for what, private creditors charge extremely high risk premiums in lending to developing countries. An investor that bought a German bond like 9 years ago and got 0% interest rates, made essentially no profit. If you bought a loan from a least developed countries, you made 8% per year, so you made already 72% profit on your investment. So in my view, this is only justified if the amount of principal that is to be repaid is to be reduced by the same amount. And this is an investor language to be understood. This is also related to your point, Anna, comparability of treatment. Official lenders, multiple development banks, have been lending at a rate of 1% to LDCs. Private investors ask between 6 to 8%. So official lenders have been subsidizing private lenders all along, have ensured usual profits. And I think there's a responsibility by official lenders, by bilateral creditors, when we talk about comparability of treatment, to ensure that the haircut taken by private creditors is much deeper than those by official lenders. Otherwise, there's much to say. There's an interesting question by Alvik in the chat on the links between the financial sector and debt restructurings. This is an extremely complex one, but let me just go back also to my point on financial crisis. Of course, there's a sort of doom loop. If there's a debt crisis, the sovereigns don't repay the debt. Usually, the banking sector is also affected. We had bad experience of this in Europe during the Euro crisis. So this is definitely not a point from my side that we should not do any debt restructurings, but there should be also mechanisms in place to ensure that the taxpayer citizens are not being bailed in when it comes to bail out the banking sector. So countries, governments need to ensure that private banks that there are high capital requirements for private banks, that there are insurance mechanisms where financial institutions insure themselves rather than expecting financial sector bailouts, because there's indeed this famous bailout between the banks and the sovereign debtors, and we need to make sure that it doesn't backfire when we campaign for private debt relief, that in the end financial institutions come back to the taxpayer and want to be bailed out, because we have seen this in Europe quite a lot in the last crisis. Yep, and then otherwise, thank you for a very interesting event, and well, great to work with you.
Thank you, Bodo. TM, your final message and what you'd like to emphasize.
On the question on what happens on a default, the short answer is nothing, but the long answer is to look at who is the default on. So if it's defaulting on external private creditors, the impact of that is not being able to borrow more high interest loans from those creditors. But normally that has already happened. At the moment, countries like Ghana, Pakistan, Laos are not able to borrow any more money from external private creditors. So the actual impact of defaulting in a negative sense is nothing. The positive is you're not losing all that money anymore. And so my key message again is that I think the private sector have created this narrative to tell us that restructuring in default is a really difficult thing to do, and it isn't, and we need to kind of help challenge that messaging rather than play into it. As Bodo was saying, it's a very different situation with defaulting on domestic private creditors, which is it's a domestic issue. Who are those creditors? What are going to be the knock-on impacts on banks and things? And that's for government and people in an individual country to look into. But in a sense of if a government does want to restructure those debts, then also it's easier because you have legal control over those banks and over the law the debt is owed under. But yeah, I think I've written a long message to Anna in response to the question on the standstill, but it all comes back to the same thing, that I think the private sector and the G20 keep trying to create these barriers around credit ratings and never being able to borrow again. And all of it is just not true. The situation we're in now is there's been a massive flight of capital from the global south to the global north. Global north private lenders are not willing to lend more. So there is very little negative consequence and lots of positive consequence from stopping paying them. Thank you.
Thank you, TM. So before I call on Pooja, a reminder of the evaluation link that so please if you could kindly fill up. So Pooja, your major messages as a way of summing up.
Yeah, I mean, I see a question on the possibility of, say, like some of these vulture funds being located in tax haven and secrecy jurisdictions, and that is true. I mean, there is a link there, and I think it comes back to the point of making those linkages of volatility of financial flows and how we look at these kind of systemic issues in a broader sense. But I think my final message in terms of our advocacy strategy is that in terms of decision making on how we address these crises, for me, if that doesn't involve global south countries as being part of that decision making, then that is not good enough. And I think it also requires all of us, I think, to reflect in the movement if we're inadvertently empowering these sorts of undemocratic forums by continuing to, I think, focus on them as, the people who will resolve this crisis. And I think we really need to focus on much more democratic systems needing to be in place. Thanks.
So that's one opportunity we have at the UN, that we have a seat at the table that's being emphasized by Pooja. So finally, Yolanda, if you have additional thoughts that you'd like to share with participants.
just one short thing, because in some occasions we present like two options. Either we push for developing countries to stop paying, to default, and therefore force a negotiation and force a probably better outcome from for those countries from their creditors, or we devote our energies toward this systemic reform that both Pooja and I were mentioning. And I think both those strategies are interlinked. So the more active and probably aggressive action from developing countries in terms of not paying and defaulting, the better chances we have for a better multilateral reform. So the stronger voices, but not just voices, also actions in terms of defaulting and not paying their debts within the global south, the better outcomes we can get also in these UN negotiations for a multilateral debt resolution mechanism. So I think both strategies are very much interlinked.
Yes.
I'll finish with that.
So yeah. So thank you, Yolanda. Thank you, Bodo, Tim, and Pooja for being part of us this afternoon and really sharing your very insightful thoughts on this issue. And of course, our learning continues. We know that this is not our last encounter, and that as the challenges grow bigger, we will remain shoulder to shoulder in the growing worldwide movement for debt justice. So thank you very much. Please watch out for the YouTube version of this webinar, and we've been also live streamed on Facebook. So thank you all, and keep safe, everyone. Bye bye.
Bye. Thank you.
Thank you. Bye.
Bye.
Bye. Thank you, everyone.
Thank you, everyone.
Thank you to all our speakers. And thank you to the participants. Bye-bye.